Eric was 23, broke, and fresh out of college. He had just landed a job at General Motors, the kind of job people told him to be grateful for. But something didn't feel right. He looked around at older co-workers who had been there for decades. They weren't excited. They were just surviving. One had a golden watch from 25 years of service. The other, a dream of retiring someday, if the market cooperated. And that terrified Eric. He realized something early that most people don't until it's too late. Time is the most expensive thing your paycheck steals. And if he didn't do something different, he'd be stuck trading it away until 65. So he made a decision that most people never do. He started investing, and not just spare change. He made it a mission. By the time he turned 43, Eric wasn't stuck in traffic or asking his boss for time off. He had a $1 million portfolio. And more importantly, he had bought back his time. Whether you're 25, 35, or even 45, this story applies to you. Because in this video, I'll break down the exact steps Eric took to go from zero to financial freedom. You'll learn the simple rule he followed to save his first $20,000. Why the first $100,000 is the hardest, but also the most important. And how he resisted bad investments, market crashes, and FOMO, even when his friends got rich quick. We're not talking about lucky bets or get rich by Thursday schemes. This is about real investing, real discipline, and real results. If you stay with me to the end, you'll walk away knowing exactly how to build a $1 million portfolio, even if you're starting late, earning average salary, or made mistakes in the past. And you'll see why doing this one thing now could save you 10 to 15 years of your life later. Because for Eric, and maybe for you too, time freedom is the ultimate dividend. So, how Eric went from zero to $1 million. The first time Eric ever thought seriously about money was because he tripped at the library, picking up a book for his mom. He stumbled into a stack of books, literally, and one of them slid out onto the floor. The Richest Man in Babylon. It wasn't part of the plan, but he picked it up anyway. The back cover promised an assured road to happiness and prosperity. Eric thought, yeah, right. But he took it home, and there, buried in those pages, was the line that would change everything. Pay yourself first. It sounded simple, but it hit hard. Before paying rent, before groceries, before the phone bill, pay yourself. So he did. He just set a rule. Every month, he would set aside 10% of his income before rent, before food, before fun. At first, it felt small, $1,000 a month. What difference would that make? But it wasn't about the money. It was about taking control. It was about saying, this part is for future me. For the first few months, that was all he did. Now here's where most stories get cute. Eric saved, he invested, and he got rich. But that's not what happened. He started reading forums, watching videos, scrolling Reddit. One thread said a biotech company was about to explode. He didn't understand the science, but the hype was loud. He put in $5,000, watched it double in a week. He felt like a genius. And then it crashed. 60% gone, almost overnight. It wasn't just the money. It was the sinking feeling that maybe he was just pretending to know what he was doing. Most people quit there. They say, the market's a scam. They go back to saving in a high-yield savings account and hope inflation forgets about them. But Eric didn't quit. He started reading books. Buffett, Graham, Munger. He read and learned from Buffett. Rule number 1, never lose money. Rule number 2, never forget. Rule number 1. He learned the difference between investing and speculating. He learned what not to do, and that lesson cost him $3,000. Money well spent. And even with those losses, he still saved up $20,000 in 2 years. Mostly from saving. A little from investing. It wasn't flashy, but it was real. Then came the next test, the house conversation. Eric was 25 when his dad said, your mum and I want to help with a down payment. We'll give you $10,000. It's time you had your own place. It was generous. It was normal. But Eric wasn't trying to be normal. He had read Rich Dad, Poor Dad, and one line echoed in his head, a house is a liability. You want to buy assets. He politely declined. His parents were confused. His friends thought he was nuts. But he knew one thing for sure. The biggest threat to compounding is interruption. And buying a house too early would interrupt the engine he'd just started. At work, things were looking up. He got more responsibility, a small raise, a new title. He didn't upgrade his car. He didn't move to a nicer apartment. He just raised his savings rate to $1,500 a month. Meanwhile, his investments finally started doing something. He stopped trying to beat the market. Instead, he picked simple companies, ones that made money, ones he actually understood. Google, Microsoft, Walmart. He wasn't swinging for home runs. He was stacking singles. Just like Buffett said, I don't try to jump over 7-foot bars. I look for 1-foot bars I can step over. Then that year, a call came in. Stephen, top of the class in high school, now working in finance. He called Eric one night and said, "Dude, there's a startup that's basically the Walmart of the metaverse. I'm going in for $50,000. You in?" Eric asked, "Well, what's the business model?" Stephen laughed. "Oh, who cares? It's going to explode when they go public." Eric passed. But just to keep the friendship intact, he tossed in $500. Stephen said, "500. Wuss?" Eric shrugged. A few months later, Eric met Sarah, the red-headed library clerk he'd stumbled past 2 years earlier. Her name was Sarah. They talked, they laughed, they traded reading lists. Soon they were dating, then living together. Eric didn't just gain a partner, he gained a financial teammate. Sarah was organized, disciplined, frugal. They split rent, cooked at home. Their date nights were reading and chill. Yes, literally reading to each other. Her influence pushed Eric even further. His savings rate grew. His focus sharpened. He wasn't just saving for himself anymore. He was building their future. By 29, he hit a major milestone, $100,000 net worth. Charlie Munger said it best. The first $100,000 is a beach, but you got to do it. And he did. But just when it felt like things were working, the market crashed. Over a few months, the S&P 500 fell by more than 50%. Eric's portfolio back under $100,000. Technically, he was back at square one. Emotionally, he felt steadier than ever. This wasn't his first rodeo. He didn't panic. He didn't touch the sell button. He bought. Benjamin Graham once said, "Buy stocks like groceries and not like perfume." And the market was having a clearance sale. Eric stocked up. That year, his returns were 30%. The next, 45%. What most people saw as disaster, Eric turned into momentum. By 33, something flipped. His investments were growing faster than his salary. He and Sarah decided it was time. They bought a house together. Down payment, $60,000. Split down the middle. It slowed the compounding machine, but just a little. Even Warren Buffett, Eric remembered, spent 10% of his net worth on a home. They did the same. At 35, he got a better offer. Ford Motor Company. Same hours. 20% higher pay. He took it. But here's what surprised him. Some months, his portfolio made more than his paycheck. Other months, it lost $20,000 in a week. Those were the gut check moments. The kind where your stomach flips and you wonder, am I making a mistake? But Eric didn't react. He remembered what got him here. He stuck to the process. While his co-workers picked up extra shifts, Eric picked up investing books. He learned how to read financial statements. He ran DCF models on napkins. He listened to quarterly earnings calls on walks. And all of it paid off. He started beating the market. Not by much, just 4% per year. But on a $500,000 portfolio, that's an extra $20,000 a year. As his portfolio grew, so did that edge. At that point, the time spent studying companies was paying him more per hour than his job ever could. By 43, Eric reached his number, $1 million. And more than half of that came from market returns, not savings. He had bought back his time. He quit his 9-to-5, started a small wedding photography business on the side. Not because he needed the money, because he liked it. He hiked more, read more, spent more time with Sarah and their daughter, started coaching her tennis team. He was still investing, still learning, but now on his terms. And one Monday morning, he called Stephen again. "Hey man," Eric said, "do you hear that?" Hear what? Exactly, Eric said. "It's the sound of not working on a Monday." Stephen chuckled awkwardly. Then he admitted, "I made $1.2 million on that metaverse startup. I thought I was done, but then I rolled it into another one, a Starverse. They were supposed to be the Starbucks of the metaverse. I lost it all. Now I'm back at the office." Eric didn't start out with a master plan. He didn't have insider tips, a mentor on Wall Street, or a winning lottery ticket. He just knew he didn't want to trade his time for money for the next 40 years. That single thought, it changed everything. And the result? He didn't just build wealth. He bought back his life. You might not relate to Eric's job, or his relationship, or even his investing style. But here's what you can take from his journey. You don't need to be perfect. You just need to be intentional. Start where you are. Pay yourself first. Stick with it when it's boring. And protect your time like it's gold, because it is. If If this story gave you clarity like this video, it helps more people find it. Subscribe for more investing stories that feel real, not robotic. And if you're ready to take your first step toward freedom, watch this next video where I'll show you how just $5 a day can change your retirement forever.